All right, let's get right to it. How much risk should you really be taking with your money? I mean, it's probably the most personal question in all of finance, right? So today, we're going to decode your unique investor DNA, and we're using Morningstar's methodology as our guide.
Every single investor has to wrestle with this. But here's the thing. The right answer isn't just some number you pick on a scale from 1 to 10. It's way more personal than that. As we'll see, it's a journey, really. A discovery about who you are, combining your feelings about money with the cold, hard facts of your life.
So yeah, forget that simple 1 to 10 scale. The real process, the right process, is way more sophisticated. It's about blending two completely different worlds. You've got your subjective feelings about risk on one hand, and the objective reality of your finances on the other. And the magic happens when you bring those two together to create a plan that's, actually built for you.
Okay, so how much risk is right? Let's start this journey. And it really is a journey of self-discovery, not just some wild guess.
The best way to think about this is like getting a custom tailored suit. For it to fit perfectly, you need two things, right? First, it has to match your personal style. That's your psychology. But it also has to fit your actual measurements. That's your financial situation. If you get either one of those wrong, the whole thing just feels off. It doesn't work.
All right, let's talk about your mind and your money. The journey really begins inward. We have to understand the psychology behind your financial decisions. And that starts with measuring your innate willingness to take a risk, what the experts call your risk tolerance.
So how do they even measure something like that? Well, it's not just some random online quiz, that's for sure. It's done using what's called a psychometric questionnaire. Now that sounds fancy, but just think of it as the science of measuring personality. Only this one is specifically designed to create a reliable, valid profile of your financial self. It's pretty cool, actually.
And this brings us to a really critical distinction. The questionnaire is measuring your risk tolerance. That's your willingness to take a risk before you even make the investment. That is completely different from your loss tolerance, which is how you emotionally react after an investment goes south. See the difference? One is about your choices, the other is about your reaction.
Okay, so once you've done the questionnaire, you get a score, somewhere between 1 and 100. And what they do is plot that score on a bell curve. This is awesome because it shows you exactly where you stand compared to the general population. The average is right there in the middle, of 50. So you can see right away, am I more of a risk seeker than most people, or am I more cautious? All right, so we've got your psychological score. But now, it's time for a reality check. Let's talk about the real-world factors. This is where something called the Professional Judgment Matrix, or PJM, comes into play. Again, sounds complicated, but in simple terms, it's just a structured way to apply common sense and expert experience to your score. It uses these really crucial real-world factors, like how much time you have to invest and, how you handle pressure.
And this is where you see the most important rule in action. Look, even if your psychological score is a 90 out of 100, meaning you love risk, if you only have, say, 3 or 4 years until you need that money, your risk level gets capped. It has to be. The logic is so simple, but so powerful. A shorter time horizon means your portfolio has way less time to recover from a big market downturn. Time, that's your ultimate safety net.
And it's not just about time. Other factors help fine-tune the whole plan. Things like your composure when things get rocky, your past experience with investing, and just your general knowledge of how markets work. All of these play a role in making sure the final recommendation is a genuinely perfect fit for you.
Okay, now we're getting to the heart of it. Goals versus financial reality. This is the great balancing act, right? You have to weigh the risk your dreams require against the risk your wallet can actually handle.
And this all boils down to a fundamental tension. On one side, you have risk required. That's the dream, right? It's the amount of risk you need to take to hit your goals. But on the other side, you have risk capacity. That's the reality. It's the level of risk you can actually afford to take without totally jeopardizing your future if things go wrong.
So how do you figure out that capacity? Well, you stress test the plan. They use these financial models to simulate some really nasty, unfavorable, even worst-case market scenarios. And the key question they're asking is this. If the market tanks, are your essential goals, the things you absolutely must achieve, still possible? The answer to that question tells you if you can truly afford to take the risk.
All right, so let's find your comfort zone. We've done all this work. Now it's time to bring all these pieces together and actually build your personalized investment strategy.
So let's just quickly recap the journey we've been on. First, we started with your core psychology, who you are. Then we applied a serious reality check based on things like your time horizon and experience. After that, we balanced everything against your real-world financial capacity. And all of that hard work leads to one final, super actionable result.
And here's the payoff. The final result isn't just a single number. It's a personalized risk comfort range. Think of it as your financial Goldilocks zone, a specific band of risk that's not too hot, not too cold, but just right for you. It's designed to do two things: protect you from taking on way too much risk, but also making sure you don't miss out on opportunities by taking too little.
And honestly, this might be the most important takeaway of all. We spend so much time worrying about avoiding too much risk, but you can absolutely be exposed to too little risk. A truly great plan isn't just about protecting you from losses. It's also about giving you the right amount of potential for growth so you can actually hit your goals.
So I'll leave you with this question. How well do your investments match both your mind and your wallet? Because aligning those two, that's the absolute key to having an investment plan built for the only person it ever truly needs to fit,